So today we're going to be taking a look at my dividend portfolio, and we're going to be looking at a couple different stocks here today, mainly Lockheed Martin, which is ticker number LMT, and then Johnson & Johnson, which is ticker number J&J. So the reason I want to look at these is, one, I have both of them in my portfolio, as well as Lockheed Martin right now is currently down in my portfolio altogether. And then Johnson & Johnson, I'm feeling like there might be a possibility for them to have a nice little jump over the next couple of days or even weeks. So I want to see if maybe getting, a little bit more into both of these might be a good opportunity. So if you haven't been following along already, this is my dividend investing portfolio. My name is Dennis, so I nicely named it Dividend Dennis. I'm currently using M1 Finance to be able to have this dividend portfolio of over $21,000. So we just hit this new marker here of the 21K. So I'm pretty excited. If you guys are interested in getting started with M1 Finance, I will have a link for them in the show notes down below for you. That link does help support out the channel, but right now until the end of February, if you put in $1,000 when you open up your account, so if you put in that 1K, you are going to get a bonus of $30 into your account, which is a really good healthy amount to get a nice little bonus and put into your portfolio. Now, 1,000 might be a little too much for some people, so no worries. Minimum to get started is $100, but if you can put in that $1,000 to get your nice little bonus, I would recommend it, and then that way you can have a nice healthy amount running into your account. Now, with kind of everything here, before we get into those two stocks I want to talk about, I just kind of want to, show you guys how the last day or so, or last day and last week has gone. So as of recording this, the last day, we've gained about $50 in the market, earned a little bit of dividends, haven't popped into the portfolio yet, but they're there. And then we have in the last week has been really, really nice. We've jumped almost $466 in total gains. Now, if we quickly just jump to the last year, we've gained almost $4,200. This is money weighted return. So for those who are curious about the unrealized gains, we're sitting at $3,712. Let me kind of zoom in on here a little bit more. You can see a bit better. Now, just in case you don't know, the difference is this is just everything I haven't sold yet, where the money weighted returns you saw here earlier, let me clean that up. This 4,000 right here, that is money that is essentially profits that I've made and maybe sold some stocks for that profit, as well as dividends earned in total too. So that's all a combination of everything together. But anywho, so what I want to do is kind of look into some of these stocks. We're also going to bring up a website I like to use a lot called seekingalpha.com. I'll show you guys here in just a moment. So you might be curious why I wanted to talk about Johnson & Johnson and Lockheed Martin. So before I do that, just want to preface this, of course. So this is not financial advice. This is just me kind of sharing with you guys my thoughts and processes. My Johnson & Johnson account, I only have $400, so I don't have a ton of money in this, right? So it's not massive altogether for me. I think the last week and last month has been kind of just slow growth for us here, but I think what I want to do is buy a little bit more into this stock here in a little bit for a couple different things. One, it's a very small portion of my portfolio, and I do kind of want to buy into it just a little bit more. With everything going on, there might be a possibility that they have their own vaccine coming out, which will take with just one dose instead of two. So that is huge because obviously that's less that we have to worry about and less we have to go through with logistics. So I think that can help it, similar to how when Pfizer announced their stuff, that they had a nice spike as well. So again, this is not a lot in my portfolio. It's actually currently underweighted in my overall account. So putting more is actually going to be really beneficial to hit my targets that I set for it based off of my percentages. So that's going to be nice. And we're going to look into a little bit more here through Seeking Alpha. So let me just make sure we can see everything here on the screen. So seekingalpha.com is what I like to use. And it's kind of cut off a little bit here on the very top there, but let me just there we go. So you can see that it says Johnson & Johnson. Current price point is $161.73. If you have the opportunity to do fractional shares, this price point doesn't necessarily matter based off of all the numbers and things we're looking at. M1 Finance lets you do fractional shares, as you might have seen here. Let me go back here. So if we saw here, I actually own 2.46 shares of Johnson & Johnson. Again, I know that's not a lot of money, but hey, every little bit counts and we are moving forward, and that's the big thing. So I love the fact that we can get fractional shares. So the actual stock price doesn't matter as long as all the other numbers we're going to be talking about make sense. And that's a big thing that we're going to talk about too, right? Is making sure that this makes sense, that, I understand maybe for some people buying $161 is way too much, but fractional shares, then we are solid to go. So right now you can see the PE ratio is at 20.36. So that is a really solid number that we want to kind of look into, making sure, that it's relatively around 20, which obviously that one is. And then what we're going to do is go over to the dividends tab. Now for the dividends, we are going to look at some stuff. Now, if you followed along with me before Seeking Alpha, this kind of looks a little different. So we got to kind of adjust some stuff here. So here in the dividend summary, this is what I really like to get some information on, making sure that I have companies in my portfolio that are going to help me grow my dividends, because I want to live off of dividends in the future if I wanted to. Ideally, in about 15 years, I would like to make about $10K a month in dividends. Now, that's going to be a tall order, but I think if we stick around to it, I think that will be doable for us. And if you guys are going to be following along, make sure you hit that subscribe so you guys obviously get notified with new videos. But that's not the important part. The important part is looking at these numbers. So current dividend yield right now is 2.49%. So they do pay out quarterly. And because right now their annual payout is $4.04, that means right now with my dividends, I'm getting $1.01 for every share I own. Or like you saw here earlier, I have fractional shares, right? So that means I'm going to get fractional payouts from them. So if I go here, I was looking at that stuff earlier, just like breaking this down for you guys, because I think this will help you out. So if you can see here, I still got $2.42 with my last dividend payout on December 8th. And obviously I own portions of shares too because of the 2 point whatever. And so you're okay to get paid out in fractional dividends as long as you own those shares by the payout date, which if you don't know, we'll tell you here on Seeking Alpha. So this is the payout date you'll have, which, by the way, you'll need to make sure you own the stock before this date. So technically, for this next coming up dividend, when they announced it, you need to own it by February 21st. I don't know if that's a weekday or whatnot. That's a Sunday. So you'd actually have to have it by the 19th of February in order to get this payout. That's the payout date, and then this is the record date. So you need to still hold on to it by this date, and then afterwards you can sell. Anywho, what we want to do is kind of look at some other data points. So if I want to keep investing in Johnson & Johnson, I want to make sure that their numbers are sticking around to numbers that I would find ideal for long-term growth, right? So payout ratio is a big deal. This is how much of the actual dividends that they're paying out versus how much they have. So ideally, you want to be around 60 to 70%-ish payout ratio, depending on the type of company. They're at 50%. So this is a pretty healthy number right over here for us. So this actually is a good indicator here for us to say, okay, that's a good payout ratio. You can see that they've been paying out their dividend growth for over 58 years. That's never a guarantee that they're always going to be paying out, but that just shows that, hey, look, there is a consistency with this company, and they obviously are focused in on making sure that they can continue to pay out those dividend growths. Now, for me, dividend growth is a big factor when it comes to building up my yield, because for a lot of people, you hear about 4% dividend yield is kind of like the goal. Well, for me, I don't really care if it's 4%. As you can see earlier, we talked about how their yield is 2.49%. So this is vastly different between the two. But what actually gets this number to look really appealing for me is their dividend growth rate. This number right over here is huge for me. Now, 6.17% is not the best that I have, but being that it's in the medical field and I do want to be diverse in my portfolio, I'm pretty happy with this, especially for 58 years of growth. And what this entails is that eventually over time, when I do need the dividends, if they can stick to this or hopefully higher rates every year, that this dividend yield for me, which would be called the yield on cost, is going to get close to that 4% and beyond, just because of the fact that it is growing every year. And I'll show you what I mean by this. So let me clear this up. So here, we're going to go to the dividend news, and we're going to see how, just more recently since recording this, back on January 4th of 2021, Johnson & Johnson announced a $1.01 share per dividend, per stock. So that is pretty much on par with what they had before. But if we kind of scroll back here a little while ago, so it's April of 2020, so almost a year ago, you can see here that they actually raised their dividend from 95 cents to that $1.01, which was a 6.3% increase. And that's huge because that is you increasing the value of your dividends without having to buy any more into the stock. And that's huge for me because that 6.3% is like a raise, right? Now, granted, with the small dollar amount that I have in Johnson & Johnson, it's not that big of a difference. But, I mean, look at this. It's 6 cents essentially. That's a terrible 6. Let me redo that. So it is 6 cents per share difference, right? Again, not a lot, but when you add up how many shares you could be having over time, or if you've bought a lot of shares of Johnson & Johnson, that 6 cents will add up, and that's per quarter. So that could be huge. Now, like I said, my example is not a lot for this stock, but I do have stocks with a lot larger percentages or a lot larger amount of shares. So 6 cents could be a huge increase overall. Now, for us, like I said, 6% is good. Anything above 10% is just stellar to me because that's double-digit growth in dividends. So I'll still take the 6.3%, especially since the Johnson & Johnson fund, you saw here earlier, is a small portion. My health sector is only 5% of my portfolio technically, but Johnson & Johnson is 40% of that sector. So for me, that's still a good amount. I mean, I want it to go higher, but the health stocks don't tend to go up as high as some of the other ones, which is why I have like my tech a larger percentage, my growth larger, my financial larger, real estate, retail, all those are a little bit higher than health. But nonetheless, still going to be good. So my thing is, okay, do I want to add more into this stock because of, their dividends have been doing very well as far as staying consistent, has had good growth. And then let's go look at the yield on cost. And so this is going to also help me make a decision here. So let's go over the last 10 years. This chart is read backwards. So this is year 0. So this is where we currently are, like you are here. And this is 10 years ago. So the way this chart works is we kind of read this way. So what we're going to do is actually kind of take a look at this. So buying into the stock right now, you're looking at about that yield we were talking about earlier, if I can get it as close as possible. So you're looking at 2.5% yield currently. But let's say 10 years ago you bought into this stock with, let's say $10,000 or something like that. If you didn't buy anything more into this, the share price at the time was $62.66. The yield on cost, it says here, it's 6.45%. But that's not necessarily what the yield was back in the day. The yield was probably closer to like 2.5% or something like that. But the yield on cost makes this yield look much higher because the increases that have happened over the 10 years. So depending on when you bought it, if you bought it 5 years ago, it'd be about that 4%. Remember, we were talking about 4% is kind of the goal for most investors. But if you bought it 10 years ago, you'd be at 6.6% or 6.45%, somewhere around that range, which is a huge return on your money. And that's only in 10 years. In 20 years, let's go ahead and switch this over. You'd be getting closer to anywhere from 8 to looks like 9% yield on your money. And that's a good yield on your money year over year. And it would keep growing if you kept having that money in there. And so that's why I focus on the dividend growth, not necessarily just on the current dividend yield because of stuff like this. So me buying into Johnson & Johnson right now, let me go back to all this. So right now you can see that they've been doing really well. Obviously, during the early 2020, they dropped all the way to around, 111? So, I mean, if you invested into them right during that drop, you had already been stellar. But even if you're investing throughout this whole time in 2020, they weren't really doing a lot when it came to growth. But they were staying pretty consistent. Now they're starting to move up a lot. They are very close to their 52-week high. So buying in now can be a little dangerous because if they're at their 52-week high, does that mean that they're most likely going to recorrect and go down, or can they continue to go back up and have even more opportunity for growth? But as much as I would like to have that nice growth, I also do care about the dividends. And like we talked about earlier too, actually, let me see if I can go back here. Let me go to the portfolio. So before we talk about that, like I said, I have 2.46 shares, and then their current dividend is 2.49%. So if this coming up April, because that's when they would increase their dividend, if they do an increase in their dividend, that means what I buy into now and I'm going to get more dividends in the future is going to be having a higher dividend yield because I bought in at this price point and maybe the stock continues to go up. Maybe they have that good news. Let's see, we'll go to summary. We'll go to news here. So you can, there's a bunch of news we can read about and seeing that, is there a possibility that there's going to be some really good stuff coming out of Johnson & Johnson. Like this one right here says poised for a blowout. All these different things. They were talking about the vaccine. If they have their vaccine come out and it's, really nicely received, that there's a possibility that they'll have a really nice growth on their actual stock price, which then lowers their dividend yield, right? So their dividend yield will actually go down if their stock price goes up because now it's more expensive to buy in. So maybe buying in now could, be a good point, because then if the stock goes up in price, then I would only be getting a smaller yield if I bought in at that higher price point. So I think for me, in my current portfolio, I am probably going to be doing a good chunk, not a good chunk, but a decent size amount for my next deposit, because I do a weekly deposit to go into Johnson & Johnson. I'm not going to be putting in enough for one full share. So again, I know this might seem minimal, but for me, it's still going to be a decent amount based off of what I currently own in the stock. And with that said, I'm going to show you guys the next one, and maybe this will kind of help a little bit more too. So I'm going to look into my Lockheed Martin account. So here's Lockheed Martin that I have, so ticker number LMT. So you can see this one right here. I'm technically down entirely, and I'll actually go into my unrealized gains to show you. I only own 1.78 shares. Now, per share, I'm paying $364, so my total value is around $607. So obviously more than Johnson & Johnson, but still quite a bit for, considering the price point of these shares. And that's what I love about fractional shares, by the way, is just this opportunity to buy into larger stocks in smaller price points and still have value and growth. Obviously, this one is in the negative, so it's a little different. But what I want to do is show you here in the holdings page on M1 Finance. I like coming into here a lot. And you might hear a phrase called dollar cost average. So a lot of people call it just DCA. So DCA. That looks nice. So DCA is called dollar cost average. And what we're doing here is essentially when a stock price goes down beyond the point where you originally paid for it, then you are lowering your average price point. And I'll show you here in a second. So here on the holdings page on M1 Finance, I like to go through these, and I'll click on this part right here that says unrealized gains. And at first, when you click it the first time, it'll take you from the very top, the companies that have given me the best returns percentage-wise. You can see Tesla's here on the top, Discover, Ally, Starbucks, all these, right? If I click it again, it'll flip the numbers over, so it'll show you the ones with the lowest percentage. So right now, I only have 2 stocks in my overall portfolio that are in the negative return, one being Lockheed Martin, that we're talking about here today, and the other one being AT&T. So you can see AT&T is down about $31, which is 3.76%. And Lockheed Martin, I'm actually down $43.88, which is about 6.74%. So the reason I like looking at this stuff is because I'm saying, okay, now it's easy to visually see what I'm down on, which is Lockheed Martin. So I'm going to go over and click on the portfolio again, and we're going to go look into my industries tab. Actually, let me jump back out of my industries. Just to give you an example, my industries is about 9% of my overall portfolio. And so if I click on here and then I look at Lockheed Martin's about 28% of this overall pie, with Nexair Energy being a majority of this. So this is not a big portion of my portfolio, but again, every little bit counts. We're diversified. We're building up the blocks so that way in years to come, we're solid, right? So if we look on here, first thing you're going to notice is that on this page, my gains are actually less than the other amount. I think it was like $40-something here. It's negative 38. So the reason for this is because this is money weighted returns. So my dividends that I've earned, which is about $5.19, gets added to the total negative gains, which gives me the negative 38 instead of the negative 43. So in case you're confused about that, that's why it's counting the fact that if I didn't own the stock, I wouldn't have gotten gains on my dividends or earned on my dividends. So it does count it on there, which I kind of like, just so that way I know that, that $5 is included in their total. But this is what I wanted to show you. So this is what that DCA is, dollar cost average. So with the 1.78 shares that I own of Lockheed Martin, on average, I've been paying about $364.22 in this stock, right? So if you look at the current stock price, though, it's at $339.67. So you can see that there's a difference between these two numbers. Obviously, the stock price is less than what my average share price is. So dollar cost average says if I buy more at this price point, my average share price will go down, which is cool. That means because I'm buying in less than what I originally started this account with or what my average was, that this is going to keep going down. So it keeps going down, down, down. Obviously not by large margins because one, these two price points aren't vastly different. And I own a healthy amount to not make that huge unless I start buying a lot all at once, right? If I bought a full share at $339, this average share price would probably go down a lot faster. But what this is really doing, let me clean this up here. Oops. Carry that over. So let me close this over. So what this is really doing for us is saying that, okay, so yeah, I bought at this price, and yes, the price point is currently less than what I originally paid for, but I, one, looked at the metrics for this company and I still want to be invested in them. So buying in now just means that when the stock price, eventually goes back up, that I got in at a nicer price point and essentially got a discount for a company that I knew that I was going to be keeping for the very long term. So let's take a look on Seeking Alpha. Let me go ahead and go here. Keep dragging all my stuff around. So let's go ahead and go here. So what we're going to do is go to Lockheed Martin. Gotta delete that stuff off the page here. So let's go ahead and take a look at them all together. So similar to Johnson & Johnson, hopefully this helps you guys out. And if you're curious with Seeking Alpha, they have these analysis from different people. They have the news here as well, so that you can gain a lot of insight on, should I go here? Should I be invested in this company? So the PE ratio here is 14.10. So that's really great, especially when you're considering, 20 is around the average. Actually, right now it's way above average because of some of the companies out there. But you can see here on this chart that they've definitely had a downward trend lately. And I've actually been buying down this trend. And it can be hard because for a lot of people that it feels like you're trying to catch a falling knife. And that's kind of a terminology people utilize. So for me, I'm okay buying in during this downtime, even if it feels like I just bought in and the price point keeps going down, because it feels like you could have just waited, but you just don't know if the stock starts going back up again or if it's going to keep going back or it's going to keep going down. So you're kind of playing this like risk reward kind of situation of, do I buy now? Do I wait? Or do I do a little bit of all? And I like to do a little bit of all. So I'll buy while it's going down. And if the next day it goes down even more, then I might buy even more of it. So sometimes it depends on the level of it going down, but we'll see here. So right now, if we look at the 52-week high, it's almost right there in the middle of the 52-week high. So their lowest point was 271, and their high point was 428. And I believe that 428 was right before the market crash in February of 2020. Yep. And then their lowest point was during that crash in early 2020. So everything after that has been kind of just like steady in that area. And then it's been a nice slow decline here over the last couple of months. But because I still believe that I'm going to hold on to this company for the very long term, I'm going to go over these numbers as well here. So you can see here, so the dividend yield is currently at 3.04%. Actually, before I do that, let me jump back in here. So I just don't want this to like sign me out or anything. So I just clicked on that. So this dividend yield, like I said, 3.04%. Their annual payout per share is $10.40. Since they do quarterly dividends, that is equaling out to $2.60 per share per quarter. Pretty awesome. Not bad at all. Their payout ratio, if you check this out, is pretty much at 43%. So it's well below, our expectations of anywhere from 60 to 65%. So that's really nice. This also means that there's opportunity to increase the dividends if they wanted to and needed to. And you can see here that their dividend growth has been going on for 18 years. So that looks really, really nice. Now, we talked about that 5-year dividend growth, right? Because remember, this is not even at 4%. So 5-year dividend growth, this is almost at a 10% growth rate. That is fantastic. Remember we talked about double digits? Love them, right? It's not always the case that they're going to be there, but double digit growth is really nice. So let's take a look and see how they did since their last dividend increase. So you can see here, back in September of 2020, I've already been owning them. They actually increased their dividend by 8.3%. So a little lower than their average over the last 5 years, and that's okay, right? During especially a year of a lot of uncertainty, but they still grew a pretty healthy amount. They went from $2.40 per share to $2.60 per share. So that's a 20-cent increase per quarter. Can you just imagine if you owned multiple shares, hundreds of shares of this company? Like, that's a huge amount of increase that you're getting per quarter. So that is really huge. And to me, 8% increase, I mean, man, I can't even imagine getting that kind of increase from, a pay raise year after year from a company. That's effectively what you're getting as a 8% raise. If we go back a year prior to that, it was 9.1%. It went from $2.20 to $2.40. So again, a 20-cent increase. So in 2 years, you went up an extra 40 cents per share per quarter every year. That is incredible. And that's what gets you that yield on cost, which we'll take a look at here in a second. Just want to go back to this. So again, it doesn't clock us out. So let's go look at the yield on cost for this company. So let's go 10 years out. All right. So again, this is where we're at. This is where we were 10 years ago. So look at this. So if you buy now, it's about that 3% yield. Check this out. 10 years ago. Oops, let me close that out. 10 years ago, if you bought exactly 10 years ago, your yield on cost, if you didn't buy it again, if you didn't do anything else, you just, let's say you put in, $10,000 worth at $79 per share. One, the value per share is increased immensely. But then look at the yield on cost. 13%. Can you imagine getting 13% on your money every year for having that stock? That's huge, right? But like, people don't see those numbers, so they don't see the value in it, because what they see today is 3%. And because people say, hey, don't get that 3% yield, get that 4% yield, they're not going to, hold this stock and hold it and be patient with it, because obviously it takes time to get to this point. Now, because I don't want to use the money that I have in my portfolio for another, I was making a dollar sign, for about another 15 years, I don't need the dividends that I'm earning here today. I want the dividends I'm going to earn here in about 10, 15 years over here. So all this time right over here until I get to this point, it's okay. I don't care what the yield is, as long as the dividend growth that happens year after year, right? From this year to this year to this year, is just constantly moving upward. Ideally, if I can get double digits, that'd be great. But even if it's less than, 1 year at like 5% or 6%, it's still moving forward. It's keeping up with inflation, if not more than that, then that's fantastic. But I think for a lot of people, they see this lower yield and they just don't want to go for it. Now, with Lockheed Martin, the interesting thing about it is the fact that, if we go back here, I'm down on this, almost 6.7%, right? And so for a lot of people, that scares them. That scares the crap out of them, saying, whoa, I bought into this company and I'm negative. Well, if you're holding long-term, if you're a long-term, especially a long-term dividend investor, this doesn't matter in the slightest today. If anything, the only thing that this means is that you can get a sale. Jeez, I keep covering it. You can get a sale of 6.75%. Because imagine if this stock goes back up, where it's projected to go. I don't know for certain. Obviously, I could base off of numbers and stuff like that. But like, look at this track record here, right? So there was a point where it was hitting its peak, and then it goes down for a couple of months, even years, and then it comes back up. And then it's doing great. And then it has a dip, right? And it goes down. But then look at the growth over time. And then it has new highs. And then it dips and it goes back up. Dips and it goes back up. So when it's dipping, these parts right here, this part right here, I didn't own this back then. But if I did, right? These spots right here, I would love to have the opportunity to buy in these spots, which is what I'm doing now. I'm doing it right here. And I think I did a little bit over here. I wish I did more over here. But these were the times I had the opportunity. The times I don't like to buy my stocks is when they are here, or they are here. Obviously, I don't know that those are going to be their high points. So I usually buy in smaller amounts. But then once I see these huge dips, once I see them go down, that's when I start buying more. So if I go into my fund over here, where is it? So if I go into my activities here, let me close that off. And I'm going to show you Lockheed Martin. So let's bring this up. So right over here, so you're going to see this, and it's going to be pretty cool. So you can see here back in like November, I was putting in $10, $10, 15, 10, 10, and then you just start seeing like $21, $25, $40, $40, $20, 35, 25. Why is that? Well, the reason is because I kept seeing the stock going down, but knowing that I want to hold it for long term, so I want to keep throwing more money in. It was, yeah, like if you look back here, look, August, September, when they were kind of a little bit in their higher price points, I was buying in just a couple of bucks here and there because obviously I wanted to have ownership in them. Oops, let me close out the Johnson & Johnson stuff. So right over here, yeah, you can see these larger dollar amounts that I've been buying into just over the last couple of months, right? December 28th, $40. December 22nd, $25. But like before that, they were just small dollar amounts. So when my stock that I have is going down, I like to buy more. When the stock is going up, I like to buy less. So that's just my method because I'm long term, right? I'm going to be in this for 15, 20, 25 years. Who knows exactly how long, but I know it's going to be long term. So when the stock, I'm going to do it again. This is bad to write on. So when the stock is going down, I buy, right? Oops, there's the U, B-U-I. When the stock is up, so stock is up, I buy less. Doesn't mean I don't buy any more. I just buy less of it. Just because if the stock is hitting their 52-week highs, there's a chance of correction happening. Now, we talked about Johnson & Johnson, how it's at its 52-week high, but because of some of the news coming out, I feel like there might be an opportunity for us to get more into our Johnson & Johnson stock. And you know what? If the stock doesn't happen to pop and go higher and it goes down more, I'll just buy more. I'm not going to be afraid. You know, if it goes down, I won't be afraid. I'll just buy more into this. I'll lower my average share price if the stock goes down again. But I'm not going to be afraid to buy in, in smaller amounts if I needed to. But that's kind of the way that I look at things. I figure out that, long-term investing, I'm going to go back over here to show you. Long-term investing with my dividends, I want to get those yields on cost being 10%, 15%. I mean, these crazy numbers here that you're going to see once I get this loaded up. I mean, can you imagine 20 years ago, you'd be getting 31%, because I just put in the 20 years, you'd be getting 31% on your money year over year. That to me is insane. But people don't see that because they just see the current number, 3.06%. That's not a great yield on your money right now. But if you're holding it for 20 years, I don't know about you, but I want 30% on my money and I don't have to do any work. I get increases year after year, like sign me up. That's what I want. So, it's just a matter of what you want in your perspective and where you want to be with your portfolio. I talked about M1 Finance already and how much I love using this platform because it kind of limits me on how much I can do in the market on a given day because of kind of some of the restrictions they have. And I'm okay with that because I have Dividend on my portfolio, which means I'm a long-term investor. I mentioned earlier, if you guys do want to try them out, I will have a link for them in the show notes down below. It really does support out the channel and helps me out to continue to provide free stuff like that for you guys. Put in that first 1K when you sign up, and then you guys will get that $30 bonus up until the end of February. So make sure you guys do that as soon as you can. And then the other thing I want you to do after you are done signing up is check out my next video right over here. This is going to help you keep on your path to investing and sticking with it because you're watching and learning more every single day. My name is Dennis, and I will see you guys in that next video.